G'day Money Miners, the weekend special, and I'll tell you what, get WA water bores in your head. JD, water exploration monitoring bores, mine site dewatering injection bores. Mate, if you ever say the word bore, it means you call WA water bores, and the number to call, it's in the show notes. And I think of WA water bores, and that just brings Roscoe Widdup to my head. JD, doesn't it to you?
Mate, you were that keen, you couldn't even wait. It does.
What?
Roscoe Widdup, should we tell the audience a bit about the man who we are interviewing?
Well, you might remember the surname from Mr. Hedley Widdup.
The one and only brother of Hedley Widdup, former guest on the show.
He might have other brothers, we don't know.
He might, that is right.
What'd you yarn about, JD?
Mate, Roscoe runs 888 Capital. Got a couple funds, a clean energy fund and a gold fund. So very interesting. He's a super thoughtful guy. And we just, broke up the conversation in two parts, one on the clean energy, one on the gold fund. He's got a pretty broad remit on the gold front. He can invest in bullion, miners, royalty companies, whichever way he wants to play that thematic. He's pretty bullish it. He calls gold bullion the best performing asset class of the past 2 decades.
I think he's got a big chunk in Franco-Nevada, doesn't he?
He does. We had a bit of a chat about that, and he's quite methodical about how he picks it. He's got a bit over in North America, which is a bit of a common theme we've seen with some of the fundies we've spoken with lately, just seeing that disparity in valuations. And then on the clean energy front, he can go from, one end at the consumer side of the supply chain all the way to the miners at the other end. So we spoke about solar, we spoke about EV players, we spoke about MP Materials and Lynas and why one's better than the other. Pretty wide-ranging conversation. He shared his thoughts on nuclear, uranium, the thematic, the valuations in the space. So we got into the weeds on a whole bunch of different stuff.
Mate, the supreme pizza of mining and finance this episode, JD. She's got everything. Let's bloody rip in, mate. Another great job by you, as always, on tour.
Cheers, mate. Here is Roscoe Widdup.
G'day, Money Miners. I have got Roscoe Widdup here with me, the co-managing director and portfolio manager of T8. Thanks for making the time.
Thank you for having me.
So you run a couple strategies, a couple really cool ones, which are pretty relevant to the Money Miners, the people who listen to our show. You've got a clean energy fund and a gold fund, and I'm very excited to chip away at your knowledge over the next hour or so and see what I can glean off you. I want to start with the clean energy fund. So just the name straight away comes with a whole bunch of connotations, meaning different things for different people. And I know you've spoken in the past, or you've written in your reporting about the myths in and around clean energy, perhaps the fundamentals, the actual returns of the businesses. So why don't we start by dispelling some of these myths that you see out there in the market?
Sure. Well, look, and it's a broad church, as you pick up, but let's start with what we invest in, and I think that'll provide some context with some of the myths that we can bust.
Sure.
We invest in global equities, and within global equities, we invest in renewables, energy storage, and electrification. And within those verticals, we will invest in anything from a consumer product or service all the way to the beginning of supply chain to critical minerals, critical raw materials, mining companies, and anything in between. And our process is all about finding those fantastic businesses that are typically smaller companies, typically less than 10 to 15 billion US dollars of market cap. And they are not in major indices and not on the radars of most fund managers, and have got an incredibly bright future because of what's happening in our world with the rapid adoption of a whole lot of new technology, which is clean energy.
And that tends to be, at the moment, I think, from what I gleaned, 2/3 North American focus with a bit in Europe and the 1/10 or so in
Correct.
Western Asia, developed Asia.
Correct. That's broadly what the portfolio is. That may not always be the case. We're not constrained by geographies. And in fact, when we look at the innovation that's coming through, some of the most innovative companies on the planet are being founded in Asia. And because of the geopolitical fault lines, the way they currently sit and the way they look to be evolving, there is a good chance those companies will not be available outside of Asia as they have traditionally been.
And I assume you're always talking public equities, you won't go into the private space?
No, public only. And liquid listed equities is what we'd say, even though they are global small caps. They are still got plenty of liquidity. And with the majority of the portfolio in the US, that's US liquidity, not Aussie liquidity. And when we talk small caps, we talk global small caps, not Aussie small caps.
The small caps that we probably talk about are worlds apart from the small caps that you're referring to, given the US 10 to 15 billion market cap. The whole space has been very volatile the last few years. In particular, you started the fund late 2019. So it's been quite a roller coaster of a ride. And now the stocks are trading at pretty depressed levels. If you look across the market and the basket or the benchmark that you reference yourself against, how much of the performance comes from you understanding that the macro environment, interest rates, and how that drives the whole sector?
It really starts and finishes with the macro, and let's unpack that. But that will also give us an opportunity to unpack those myths that we didn't get to in that earlier question. The major driver of these companies has been perception rather than fundamentals over the last 2 years in particular. And the biggest macro driver and creator of those perceptions and that negative sentiment has been interest rates. There are only 2 S&P 500 sectors that are down since rates started going up in March of 2022, and that is utilities and real estate. There is only one market factor that is down over that same time horizon, and it's small caps. So clean energy, we invest in electric utilities is really at the center of what we're doing. We invest in companies that either directly produce or generate clean energy, and those that are critical to the value chain thereof. So our exposure to electric utilities has been a headwind. And then investing in the supply chain of utilities, solar, wind, batteries, hydrogen, etc. They are all in the supply chain too, or an alternative to electric utilities in many cases. And yet they are earlier stage, more volatile companies, generally smaller companies. So those headwinds have been prolific. Now you referenced the run up in 2020. Now what happened in 2020? We were coming out of the COVID crash hysteria, but with the election of President Biden and the commitment to the Inflation Reduction Act and to make generational investments and commitments to clean energy, as part of that we saw a commitment emerging that's amounted to just under $400 billion US in the form of subsidies, tax breaks, incentives, etc., credits for clean energy, which in real terms, inflation-adjusted terms, that's double what the US spent on the Apollo space program, putting man on the moon. Really significant. That created a lot of excitement in 2020 around the election of President Biden. You also had China committing to a net zero horizon also. So we had some incredible things happening right at that top level. Enter 2021, it became obvious, a foregone conclusion that we would see rising interest rates. You started to see some aversion for long duration growth assets. You started to see some aversion for interest rate sensitive assets, predicting that interest rates would be going up to tame inflation. When interest rates started going up, that's when the headwinds really kicked off. And since that time, clean energy has felt some incredible headwinds. That said, we've just published a piece of research that unpacks what's actually happened to the fundamentals. And if you look at the index of clean energy companies over that time horizon, the earnings have actually increased. The earnings have grown over that time horizon. And they've actually outgrown global equities, and they've outgrown small caps. Small cap earnings have actually declined over that time. So that has been in line with expectations relative to their soft performance. But what doesn't add up is how clean energy has been crushed when the earnings have increased. And that's been driven by negative sentiment and an extraordinary compression of PE ratios.
Yeah. So you talk about a severe compression of the multiple that these companies are trading on, despite earnings trending in the right direction. How do you see these companies reaching those levels again, bearing in mind that interest rates might not go to what they were 3 or 4 years ago? We've had the Inflation Reduction Act and similar acts, and perhaps they're still to play out, and the effects will be positively felt by these companies for a long time to come. But how do they get back up to those levels? Is it just through consistent performance and lifting the earnings with the multiple staying the same, or do you anticipate as perhaps we come into a rate cutting cycle that multiples expand again?
Yes is the answer to the incremental quarterly earnings results. Just constantly delivering is the ultimate progressive catalyst that see these things re-rate from what is depressed levels, very low price to earnings valuations relative to the market. It doesn't need, and this dispels one of the myths, clean energy does not need zero or near zero interest rates for it to be a thing. That is just not the case. Now, what clean energy does need is for a large wind project or a large solar project, or even people putting solar on the roof of their house or batteries, quite a lot of that's financed, and there needs to be some certainty around cost of capital. It's particularly important with big projects. And with rising interest rates, there has been a lot of uncertainty around the cost of capital for those projects.
It's the rate of change rather than the level itself.
And the level of certainty and the spreads to the risk-free rate, etc. And as we think anyone would observe that we are far nearer to the end of the interest rate cycle than we are to the beginning. And who knows whether the first cut will be in June or towards the end of the year or even in next year. But we're far closer to the end than the beginning, and we are seeing certainty increase around the cost of capital.
You also compared, I think it's in the same research paper that you referenced there, the coming off of how these companies were valued in comparison to the metals mining space through, I think, the 2011 to 16 period, and the oil and gas space from the 2014 to 2020 period. And you use the phrase of the return is via the escalator or the elevator rather than the stairs. Can you sort of expand on that and talk about how you see the companies being revalued in a slightly better environment?
Yeah, we think there are a lot of analogies to those sell-offs, given that they are small segments of the global equity market. They're highly technical. They're deeply cyclical. We believe there are a lot of analogues, and that saying that the recovery for those segments can be by the elevator rather than the stairs is that they are coming from such depressed levels, and as they come back into the spotlight, and the very attractive fundamentals and the critical nature of what they provide to the global economy is recognised, and the fact that they are not truly enormous parts of the market, they can be squeezed higher very, very quickly. And there's nothing to suggest that it won't be the same for clean energy.
And in terms of picking the actual companies that you like in the clean energy space, you've got a number of factors. You talk about industry leaders, competitive advantage, low capital intensity, high margin business, all these staples of a stellar company. How do you go about finding those sorts of companies at fair or better valuations?
Well, it starts with a filtering process and then research process to sift through it to a greater and greater degree. But if we start with what the total potential addressable market would be, it's about 10,000 stocks globally. By the time we've filtered out things that are not listed in investment-friendly jurisdictions or where there is insufficient liquidity, you actually get down pretty quickly to about 500 stocks. We then, from that level, go through and tag the individual companies within our own definition, our own taxonomy, our own classification system. And we start filtering for those 4 target characteristics. And those are, as you stated, industry leaders, good fundamentals, particularly margins, and if possible, low capital intensity, so they can grow without dilution risk. Great capital structure, and particularly through strong balance sheet. We don't want to take balance sheet risk through leverage in this portfolio. And then lastly, competitive advantage. So we do some filtering on that 500 stocks. We whittle it down to really the best 120 or so ideas within that, and that becomes our focus universe. From that, we select 30 to 40 companies. And the selection of those 30 to 40 companies are the best ideas within that focus universe. And they are defined by a greater assessment of those, a proper assessment of those target characteristics. We do fundamental valuations. We come up with fundamental 12-month target prices to keep ourselves honest and to know what we're playing for in the short term, not the 3 to 5 year horizon. We do institutional grade risk assessments, considering top-down macro and markets factors, bottom-up fundamental factors specific to the company and the industry, and responsible investment factors, which gives us a really unique lens on risk. Positions are then sized based on reward relative to risk. High reward, low risk, large position size, and the inverse is true. And we also consider whether we've got a unique thesis. We assess the quality of our thesis. Does our valuation and our earnings estimates, is it exactly what consensus believes? And if so, well, how is it going to outperform? What have we found that's special? Probably nothing. So with those three legs, those are the three key legs to how we come up with the very best ideas.
And you talk about conviction there, and you've got these building blocks that you talk about as well in your reports. In terms of conviction around, companies, often it's how we look at it in the mining space. It's the commodity tailwind. So you might be picking the best producer, but if you're picking the right commodity, they're all going to go. Does that limit you in how many companies you'll pick, for example, in the solar space? Will you just pick the best 3, 5, or if there's one that clearly stands head and shoulders above, will you just pick that one?
We look for a portfolio of 30 to 40 companies. We rule it off, and the absolute maximum is 50. And the sorts of conditions that see us have a portfolio at the upper end of that range is where we have less conviction and where the reward relative to the risk assessments are coming out as indicating less conviction, and our exposure then tends to be spread more widely. Where conviction and confidence increases, we see larger position sizes, and particularly larger individual position sizes. There's no formal requirement to have a finger in every one of those 10 building blocks. There's no formal limit to the amount that we would have in any one building block, because it is a purely best ideas driven by the fundamentals. Now, at the moment, we're roughly a third of the portfolio in solar. That is as a result of the bottom-up conviction in those individual names. Yes, there's an industry element within that, but it really relates to the valuations and the strength of the fundamentals within those individual companies.
So, let's get into those three verticals then. You've got renewables, like you said, stationary storage, and electrification. And you mentioned solar, so let's start with renewables, because this is perhaps one of the most politicised of the three, even though they can all, to an extent, quite politicised. But can you just speak again to how you see the fundamentals of these companies standing up, completely on their own legs? Because there's a notion in the market that they cannot survive without government subsidies.
Yeah. What is the main fundamental that will be driving the adoption of solar? When we talk about the sale of solar equipment to generate solar electricity, what's the main thing that's doing that? High electricity prices. And what do we see throughout most parts of the world? We see high and rising electricity prices, particularly from a regulated perspective. Why has that happened? Because we're in the process of breaking, and in many cases we've broken the way electricity generation and transmission and distribution has worked for the last few decades within major economies. We have seen the introduction of renewables, but particularly solar did this. And what introducing solar did, and at first it was subsidised, and this plays to that myth. And what solar does, it has the lowest short-run marginal cost of electricity generation. So when the sun is shining, that electricity will find its way into the grid, and it reduces the demand for everything else in the grid, which is reducing volume out of a fixed volume, largely fixed cost industry. So where you see it, if you move to a geography with a high penetration of solar, what that means is through the middle of the day, when the sun is shining, you have low or zero, or in some cases negative electricity prices. And that is a real problem for incumbent generators. That's also a problem for the owners of the regulated transmission and distribution networks because there is less volume going through that network. That's what pushes up regulated electricity prices. And if you are on the receiving end of that, if you are a consumer or a commercial or industrial or even utility, you are looking to try and decouple yourself from that. And as counterintuitive as it may be, more solar is part of the solution as well as stationary energy storage.
Silverstone are the solution for that solution, JD. Solar storage and every other bloody form of power known to man. Correct.
That is all I was thinking when Roscoe was talking.
EV charging, diesel generators, hybrid power stations, and this is only one arm of a massive mining body that is Silverstone. And look, JD, last week I went to the Silverstone Charity Golf Day.
How'd you go, mate?
They raised $27,000 for Lifeline. So Silverstone's not just about powering mine sites, they're about powering individuals and the community, and that's why they're the best in the fucking business for mine site power. So Silverstone, great job on the charity, and just keep powering mine sites.
And it's this simple. Think power, think Silverstone.
Easy.
So we saw some pretty big news not too long ago, just last week, I think, with the US, expanding its sort of trade war on China, the tariffs on EVs jumping from already quite high 25% to 100%, solar cells, I think, from 25% to 50%, and similar across the board, across a whole range of products. What does this do for, more broadly, the adoption of these various technologies?
In the US, it makes it harder to import solar cells and solar panels from China. There are other sources, and we're attracted to some of those other sources for the potential for it to improve the industry dynamics for a period of time until that new capacity can be installed and increased in other countries that are either within the US or aligned with the US. In terms of EVs, China manufactures 60% of the world's electric vehicles. The US has a huge heritage and a great history in automotive manufacturing. They will be able to stimulate that industry. It probably just needs a little bit of help and some protection from the Chinese juggernaut. But there are plenty of other parts of the world where those Chinese EVs can be exported to and sold. We have exposures in both cases to solar on both sides of the fence, and we have exposure to EVs on both sides of the fence. There's no reason why both can't benefit.
We've also seen plenty of Western automakers write down their targets, their plans for the coming years, 24, 25, 26. Does this hamper how you see the growth trajectory of EV sales globally?
It's an interesting factor. Now, the first thing we need to remember about EV manufacturing is that it is part very much of the global automotive industry. What has the last 100 or more years taught us about automotive manufacturing and that industry? That it is a deeply cyclical, pretty awful, low margin industry. And there's no reason to think that EVs will change that. In fact, it would appear to have lowered the barriers to entry to see new entrants and to make it an even tougher industry for a period of time. With the slowing global economy brought on by rising interest rates the world over, it is expected to see declining auto sales, and with that, rising inventories that necessitate production cuts from incumbent manufacturers. Now, what that does at this time within the evolution of the electric vehicle and the uptake of that technology is that it leaves that there are two automotive manufacturers globally that make EVs that are running plants at a utilization level that allows them to make positive margins, and that's Tesla and BYD. That gives them capacity to be able to discount, to take share, to continue selling, and to put even more pressure on their competitors. We observe and we speculate. In many respects, we're talking about the future, so we'll all be wrong. But this has the potential to have a lasting impact for BYD and Tesla to gather more share more quickly and to be able to hang on to it for longer because of the markets that are being surrendered by the incumbent OEMs.
So I think we've seen over the past few years the number of EV makers in China in particular dropping year on year. How do you see the industry in 5 or 10 years' time? You've sort of spoken to it there already, but is it these two dominating with perhaps some of the incumbents like Toyota gaining more of a foothold, and it normalizes again to a couple dozen less than a couple dozen that just dominate the global space?
Yeah, and history is a great thing to look at here, because we are believers of the saying that history doesn't repeat, but it certainly does rhyme. And if you look at what happened, if you go back 100 years in the US, and you'll probably remember the numbers better than I do, but there were the number of automotive manufacturers in the US was numbered in the thousands, and we saw it consolidate down to 3. That will happen again. Ford in 1920 had, I think, over 50% global market share within automotive manufacturing, and by 1930 it had declined to less than 10%, which is basically where it stayed. There is no reason to think that this time will be different. EV manufacturing will be a really tough industry in the medium to long term, and that's why there are some particular attributes about Tesla and BYD where the attributes we like least are their exposure to automotive manufacturing. The attributes we like most are, in BYD's case, they are the second largest battery manufacturer on the planet, with a huge amount of evidence about their level of innovation. Look at their growth, look at their margins, look at their valuation multiple they're trading on, low double digits, and look at their net cash balance sheet. That is an absolute powerhouse that most people haven't looked closely enough at. Tesla, on the other hand, has got optionality across not just automotive, but a suite of different clean energy technologies. What we like most, though, about Tesla, and it's a really polarizing, poorly understood, and they have disappointed the market with their guidance, it is their self-driving or fully self-driving technology, autonomous driving technology. Our reflection here is that is one of the first technologies we've seen in this AI boom that really has a chance to in the near term, improve productivity and cut costs of major industry, having a real impact on global economies. And what I mean by that is that if you automate transportation, road transportation to a great degree, and it's not in every situation, but in commercial transportation, that is a huge cost in getting goods around. And in the lowest cost jurisdictions on earth, the driver is costing you $15,000 per driver per year or thereabouts in the lowest cost jurisdictions. In the US, it's well north of $60,000 per year. In Australia, it can be pushing 200. By being able to remove drivers from the trucks for significant periods of time is a huge cost saving. Now, how do you start valuing that? Well, every indication is that technology will have very, very, very high barriers to entry, and it has the potential to evolve into a really tight oligopoly. And it is software, so we assume in the long term, the owners of the market share within fully autonomous software will earn a software margin. So if you give, of the roughly 400 million commercial vehicles globally, if you give someone 25% market share, let's say Tesla, earning a software margin on 20 times earnings, let's say for simple maths, that at $1,000 per vehicle per year license fee. That is $600 billion US of market cap. Is that what it'll go for, or might it sell for twice that? Okay, that's 1.2 trillion. 10 times that at 10,000 per vehicle per year. That's 6 trillion of market value. We reflect that as you start to disrupt these incredibly consequential industries with genuinely impactful technology, that's where we see real value creation. And that's the most exciting thing, in our view, inside of Tesla.
That's fascinating. I don't think I've actually spoken with someone on the show who's been long Tesla, much more other end of the supply chain sort of fundies.
Before we have to say long Tesla, it's about a 1% position size in our portfolio, making sure we keep it on the page because of that potential factor.
Yeah.
The factors we don't like about Tesla is we can see the competitive industry dynamics. We can see margins under pressure, and that stock has felt incredible headwinds this year, having had a great year last year. So we really lightened up coming into this year.
Fascinating. In terms of the broader auto space, we've seen a rising popularity in hybrids, in EVs, a whole sort of range of essentially hybrid type vehicles, perhaps more of a medium term type of play. Have you picked up on this? Is this something you think is underweighted or overweighted in the market currently?
Yeah, there are a couple of issues with hybrids. It's unforeseeable that they will be cheaper to manufacture and operate than the incumbent internal combustion powered vehicles, the pure ICE vehicles, and it's unforeseeable that they will be cheaper to manufacture or operate than pure battery electric. They're stranded in no man's land. They actually play that they are really accessible from an incumbent automotive manufacturer's perspective, and that appears to be why they love them. But it appears stranded. We don't believe they have a future. And for people who are focused on emissions, they are more emissions intensive to produce than an ICE or an EV, and they're far more emissions intensive to operate than an EV.
Okay. In terms of renewables on that vertical, again, nuclear is something we speak quite a bit about. How do you think about it, and what sort of role does it play in the fund?
It's very much part of our universe. One of the difficulties is, particularly at this moment in time where there is a lot of euphoria, exuberism for all things nuclear and uranium, it's very difficult to find things that are really attractively valued. And we are motivated by those fundamental valuations. We had previously had some exposure to SMR or NuScale, the small modular reactor listed technology company. You can see that stock is up over 100% year to date. That is a very long duration opportunity where on the balance of our research reward relative to risk doesn't line up. In terms of the uranium market, we're really cautious about the uranium market. This appears to be driven largely by, on the balance of our research, a lot of sentiment rather than strong industry fundamentals. And we're very cautious about that exposure. The other sort of exposure that we've had in the past has been with producing nuclear utilities. In many respects, though, there's no particular advantage to owning one of those relative to owning a utility that has got a significant amount of wind or solar. Wind and solar is far more expandable. Growth is a great attribute to have within a power utility. It's really, really difficult, if not impossible, to expand nuclear capacity in a reasonable time frame.
Some of the other holdings you've got in the Clean Energy Fund, one of them is MP Materials that I'm keen to touch on. In the sense of, how do you compare MP with Lynas, the other stock commonly said in the same sentence, and what do you make of the merger talks that we've seen earlier this year?
Look, let's start with that. Industry consolidation can be a really good thing where it results in synergies and pricing power. We love that. We're not sure what the competition authorities would say. That said, if there's ever a backdrop to get it done where there is geopolitical friction and where we're fighting against it, where the West is fighting against the Chinese juggernaut, then that might be an interesting time to contemplate it. Between the two, what we are really drawn to is, and this often goes with many situations that we contemplate, is if there is a high quality, liquid, US listed, and particularly US headquartered company, it's really hard if they've got similar valuations. It's really hard to go with the other, and in this case, Lynas. Lynas also comes with some of those well understood challenges within Malaysia, which MP is not encumbered with.
Well, can you expand upon why you prefer to choose the American over the other?
Two things: liquidity and connected to the biggest capital market on earth. What really moves stocks? It's when US investors are buying those things. More eyeballs, more capital, more potential upside.
Understood. And in terms of the sort of potential pricing power, how do you think that would actually play out? Say that the two could merge together, given that the Chinese still have such a more than a foothold, a strong position in the rare earths market.
Well, there are likely to be some buyers who are obliged to buy from Western suppliers, and
government sort of mandate type.
Potentially, yeah, and if they go from having two suppliers to one supplier, that's a pretty good negotiating position for the one supplier, isn't it?
It is. One of the other commodities you've touched on is copper, and this has made huge headways with the rising price, the dropping treatment charges, and a bit of a short squeeze sort of playing out in the recent couple weeks. But you've taken a bit of a different view at it, and that's pretty contrarian, because almost everyone I've spoken with is long copper one way or another, at least in the long term. You've spoken more to a situation where inventories are relatively high, you see supply coming on in the second half of the year. Can you expand upon how you see that in the short term, and then what your long-term view of the metal is as well? Yeah.
And we're not one to be contrarian for the sake of it. We've had, throughout our history, we have had far more copper on the page. We've had copper on the page far more often than not. We exited our copper exposures as the global economy was starting to slow down. Notwithstanding the incredibly bright future and the intensity of use in a lot of the technologies that we invest in, the majority of copper demand is still very, on the balance of our research, very economically sensitive. Slowing global economy, declining copper demand. Recall the old adage, listen to Dr. Copper. Copper is very economically sensitive. Couple that with, as you mentioned, we observe that inventories on major exchanges are at levels not seen since 2020, when the price was $3.50, less than $3.50 a pound, relative to $5 a pound today. It's well known the supply disruptions. It's well known the movement to treatment charges. We look into the second half, and our research indicates that the supply side looks relatively strong. With our research and analysis, we look at what's known, and we look at what our base case for what's likely. And in this case, we can't reconcile any of that with a real appetite to have copper in the portfolio at this stage. Our expectation is that we will be back there in the future. It's got an incredibly bright future, and I would speculate as well that if we were to estimate a long-term incentive price for copper or a long-term price forecast, I suspect we would be higher. But going back to a point you made very, very early on, it's hard to see an equity associated with a commodity going up if the commodity price itself doesn't go up. Now, this squeeze and this momentum and this euphoria could last for a little while yet, But as an investor, it's our job to work out when to sit it out and when to grip it and get involved. Further, and this is not totally intuitive, but we have a position, we have some exposure to aluminium through Alcoa in the portfolio. And our exposure to copper had been through Freeport-McMoran. Those two equities are uncannily correlated. So the fact that we had exited Freeport at valuations that blew right through our expectations with a cooling outlook for copper, we never had the sense that we're totally naked because of the way they are correlated. And actually, in actual fact, Alcoa has outperformed Freeport on a year-to-date basis. And our near-term fundamental outlook for aluminium as a commodity is we are more positive about aluminium in the short to medium term than we are copper.
Beautiful. Let's change tack slightly and talk about the other fund now. So you've got the gold fund, and when we spoke a few weeks ago, you painted quite the picture of essentially the thesis behind the fund, and you called it the best performing asset class of the past 2 decades. And
Gold bullion, yeah.
Gold bullion, yeah. I was chatting about a friend who loves Bitcoin. He might have a thing or two to say about that, but nevertheless, it's been kind of stellar going through how you've reported it and the way you've sort of set up the fund and the information you've given. So I think it's better coming in your words than mine. Can you speak to why you set up a fund focused on gold?
Yeah, but I want to start by saying that if you love Bitcoin, then gold will really appeal to you. Our sense is the dynamics that a lot of those investors like have been present in gold for the last 5,000 years.
Yeah.
But why did we set it up? We observed that boring old gold bullion with its negative holding cost and with its very low volatility has over the last 20, 25 years been the best performing asset class, better than the S&P 500, better than Melbourne property prices, as someone wanted us to comp it to. And our view is that that's very much been driven by really, really boring but really strong fundamentals. Small but constant demand growth and a tight supply side. And if you look at many of the dynamics that people talk about as why to be bullish copper, gold has actually got many of those fundamentals as well. Falling grades mined, deeper mines, structural inflation, lack of really major discoveries, higher hurdles to bring on new production, etc. Not quite as acute as copper, but certainly many of those characteristics. And our view is, so the next 20 is unlikely to be very different to the last. And if you believe that, and if that is the scenario that comes to fruition, then a small concentrated portfolio of gold producers will, if successfully executed, will outperform that gold bullion price because of their natural leverage to the commodity. What is that? It is through their operating margin and to an extent their reserve ounces. But their operating margin expands by more than the movement in the gold price. And therefore there's a roughly 2 beta that a portfolio of gold mining companies will have to the gold commodity itself. So what we're trying to do, and what's quite different to a lot of other gold funds that we observe out there, is we are not trying to identify the next big mine development or the next big discovery. We're not trying to identify the 10 baggers in a constant gold price environment. We are trying to identify the gold companies that will do a really reliable, safe job over 20 years and that will deliver that natural leverage to the gold bullion price. Gold bullion will do the heavy lifting for us. And so most of our work is actually in the avoidance of risk rather than seeking risk within those gold producers. And what's the universe of gold producers? There's 50 or 60 liquid gold producers in the world. And at any one time, there's typically about a third of those that are declining production and where cash flow is declining in a constant gold price. There's about a third that is trying to pull off a really big growth project. And there's about a third that is doing a really good job at maintaining about reasonable production, making good positive margins, notwithstanding some of those structural inflation headwinds, are sustaining mine life, are delivering cash flow, are keeping their workforce safe, are looking after local communities, are looking after the environment and cleaning up after themselves. And so the focus within the fund is those fundamentally attractive gold miners. It does require some active portfolio management. And they are responsible. We're focused on identifying responsible gold miners, which are those characteristics about community, workforce, environment, etc.
How do royalty companies play into that then?
Royalty companies are another and vital part of the gold equity universe. They're more finance companies than producers themselves, but they themselves are levered to the gold price. And what we describe those as is they are the inflation hedged gold equity beta. So they've got a positive beta to the gold bullion price. It's not as high as a pure play producer, and they are particularly attractive to us when we see cost inflation in the gold industry. So where we see in a neutral gold price environment, where we see cost inflation that's eating into the margins even of those great producers, and where we see cost inflation for capital investment, that's where we have a preference for the royalty and streaming companies, because they are not exposed to that inflation in the short term.
When you reference 50 or 60 large liquid companies, can you give an indication of what sort of market cap cutoff you have at the bottom? I know the median market cap was US 19 billion, which is, probably, well beyond the larger end of what a lot of the listeners look at, and beyond what you can even find on the ASX.
The smallest that we would have in the portfolio would be just under $1 billion.
Okay.
We typically, and that's probably a reasonable rule for T8 Energy Vision also. There of course will be some exceptions and some stocks that go through some misfortune end up a bit smaller than that, but that's a reasonable threshold to think about liquidity and the smaller market caps.
And looking at the names that I could see for the gold fund, I didn't see many. I'm not sure if there's any ASX plays at the moment. Is that a function of size, liquidity, or just performance, or valuation?
A bit of everything. And again, but we are in the same philosophy, and really it's the same investment process. We look for we build a portfolio around the very best ideas within that gold universe, within that universe of 50 to 60. And we're driven by most attractive valuation, highest reward at the lowest risk. Again, considering the three aspects to our risk assessment. There are more attractive valuations, more attractive reward for lower risk in North America predominantly at this time. We have one Australian listed position in the portfolio, that's Perseus.
Okay.
But really, if I give you some more colour on what's in the portfolio and how we break it up, that universe is made up of, and what we invest in is the majors, of which there are two, the senior mid caps. That's really where the higher quality, more dependable growth comes from within the gold industry. And these are companies that are smaller than the majors, but they're really 4 to 5 operations and up, sitting underneath the majors. We have the emerging mid caps. They are 1 to 2 to 3 operations. They are, because they've got fewer operations, the production can be a bit more volatile. The growth can be more exciting, but that comes with rewards and risk, which need to be weighed up. We have those gold companies that generate critical byproduct credits. That's typically copper and silver. Now, actually, copper and silver as a byproduct have a very similar correlation in a gold equity. But what that building block allows us to flex is where you have rising risk appetite within equities, where you have accelerating industrial demand for commodities, and maybe conditions for gold demand not quite as good because of those characteristics, well, then some exposure to gold companies that generate significant byproduct credits is a really attractive place to be. That typically means that what is classified as that sort of a company, it's, a silver company really only produces 20 to 30% of what their output is silver. So they're really gold companies in a silver company's clothing. And the last is the royalties and streamers. So there's inflation-protected gold equity beta.
So stepping back and looking at the current environment in the gold space, we've seen a step change in central bank buying really since the Russian invasion of Ukraine 2 odd years ago now. But on the other side of that, we've seen outflows from ETFs. The value of the ETFs has been growing as the gold price has grown, but there's been outflows in tons of gold. Firstly, on the central bank, is that a step change that you think maintains for quite a while to come, for the foreseeable?
Very difficult to predict, but on the balance of it, yes, because that cohort of gold buyers, of gold owners, every bit of research suggests that it moves very slowly, very deliberately, and enters a paradigm, if you like, for periods of time. We believe they've moved into a paradigm which is a change in the post-financial crisis era, where they went from being about 10% of gold demand post the financial crisis to being about 25% of gold demand post the Russian invasion of Ukraine. And why did they do that then? It's a really interesting month, March of 2022. Russia invaded Ukraine and the US put up interest rates. So that was the catalyst for a couple of different behaviours. So let's unpack that. But from a central bank perspective, they observed that the US and its allies seized Russian foreign reserves. And it would appear that every central bank took note. That's the first piece. That appears to, in our view, that's the catalyst for the significant increase in central bank gold demand. The interest rate, rising interest rates, was a catalyst for financial market gold investors to do something entirely opposite. And what that was is that, according to our research, financial market gold investors are driven by two major macro factors: real yields on medium to long dated US Treasuries and the US dollar. And with rising interest rates, rising nominal yields on medium to long dated Treasuries, that saw real yields increase from -1% to +2%, 2.5%. An extraordinary move. And that movement, you've got to look back to the 70s to see anything as sharp and as long and as steep. There were also, with US leading the charge with rate hikes, the US dollar also strengthened. Stronger real yields, stronger US dollar, they are the two worst headwinds for gold from a financial market investor's perspective. And part of it is opportunity cost. That's the real yields piece. So that leading into the rate cuts and then leading into the rate hikes and then continuing during the rate hiking cycle, you've seen financial market investors dumping gold. Going back to the earlier point, we're far nearer to the end of the hiking cycle than the beginning. And if we see a decisive peak of rates coincident with a belief that inflation is back under control, our view is the first move is you'll see financial market participants no longer liquidating gold, so no longer contributing to supply. That's the first move. The second shoe to drop is where they reverse and they start buying. And that has the potential to create a really, really incredibly tight squeeze in the gold market and could propel the gold price considerably higher. And we say in the order of 25 to 50% higher.
And how do you balance what you just said there with real rates moving sharply upward? Because if you look over the past 18 months or so, gold has performed quite strong, and that's sort of counterintuitive to a textbook that you would read. How do you marry that up?
Yeah, that hasn't worked, has it? And that would appear to be because other factors, whether it's Chinese central bank buying or Chinese consumer buying is overwhelming even that. Let's remember, of gold demand, what is declared as jewelry is about 50% of demand. Central banks were 10, now 25%. Financial market or ETF investors can be up to 15 to 20% of demand or up to 15 to 20% of supply. The remainder is over the counter and what's described as ingots, metals, coins, etc. It's the jewelry segment and that metals and coins and ingots segment and OTC is where probably some of the delta has come from. It's quite fragmented. And look, jewelry, it's worth remembering, even though we all think of jewelry and we think that's consumer expenditure, 2/3 of gold jewelry demand comes from China and India. In fact, markets like the US are far less significant, notwithstanding the really big consumer. So in our view, that and I think this would be shared by many others, is that Indian and Chinese jewelry demand is investment, is store of wealth in necklace, ring, bracelet form.
Now, how about the performance of the gold miners out there? Because there's a line you mentioned, I think, in one of your reports that versus the bullion, the miners are at a 25% record discount, and you're not the first person that we've spoken about this on the show, but the performance of the companies, at times has been a bit wanting. There's been, bad M&A or just margin destruction, just not strong free cash flow generation across the board. How confident are you in that discount to bullion closing over time?
Well, there are a few other factors, and we should go back to the peak of the last gold cycle in 2011 and look at what's happened since then. And we've seen a disconnect emerge, and it's pinches and swells at times. We're really at record and extreme length there now, which, as you say, a roughly 25-year disconnect. There are some who say, and it's rarely been wider over the last 40 years. So this really is historically significant, and the discounts are very interesting. Now, why have they happened? The first part is gold mining companies, gold equities compete with the other mining companies for capital in most people's portfolios. And since 2011, everything has been more attractive, more exciting than gold. Remembering gold's a commodity that grows at 1 to 2% per annum, gold demand 1 to 2% per annum. But copper has been way more exciting, has come into vogue, and it's had a few decent runs during that time. But we've seen in that time, we've seen the birth of the lithium market. We've seen some really powerful moves multiple times. We've seen a couple of lithium cycles in that time. We saw everyone learn about cobalt during that time and a boom in those stocks. We saw graphite have its day. We've seen nickel have a couple of cycles. At the moment, we see copper really on the top of people's lists. We see euphoria in uranium. The point is, everything has been more exciting than gold. So what sees that reverse? The other thing we've got to add before we address that is that those that have been liquidating gold bullion since rates started to go up, they are the financial market investors. They are the only investors in gold mining companies. So they have been liquidating gold equities at the same time, and that's what's driven the last move in the jaws opening. What sees it collapse? It's the gold bullion price. The gold bullion price suddenly hitting the top of people's lists. It's people beginning to chase those really attractive, really strong, fundamentally driven companies, and that's in something like gold, not dissimilar to clean energy, not dissimilar to mining, not dissimilar to the case study in oil and gas. That's what sees the recovery. They go down by a long way down on the stairs. They go up by the elevator. And there's no reason to think that'll be different this time.
Is there a company in the portfolio you're most excited about or can speak to?
the most exciting companies in the portfolio is let's talk about something like let's give a couple of examples. Let's give 3 examples. And one that is, let's start with one in the critical byproduct space. Pan American Silver. It's really one of the leading, if not the leading, silver producer globally. Notwithstanding the fact that only 20 to 30% of its output is actually silver by revenue. So it's a gold company in silver company's clothing. It has a 15 to 20 year mine life. It makes great margins consistent with other gold companies, 40 to 50% EBITDA margins. It generates solid free cash margins. It's got growth throughout 2024 in the near term. In terms of price to earnings or price to free cash flow multiples, which we prefer in this context, given how variable CapEx can be, but you're paying high single-digit price to free cash flow multiples on a 1 and 2 year forward basis with a net cash balance sheet. That's a really attractive company in absolute terms, not just within the gold market. Another factor is silver, is its beta to silver. And that's just starting to come to people's thinking. Silver, the perceptions around silver, to our reckoning, is that it's perpetually gold's poorest cousin as a really poor precious metal, where there isn't a really exciting source of industrial demand like the PGMs have, the platinum group metals have. It's a really fragmented demand side. And what are the major uses for silver, or have they been historically? And it was film photography, and this is part of the story of silver. The peak of demand for silver from the film photography industry was the year 2000. And over the subsequent 23 and a bit years, we've seen demand for silver from the film industry decline by over 90%. We've seen that industry really, that demand source absolutely vanish. And that actually, I don't think we can underestimate the impact that has had on the silver market in terms of perceptions about the metal, its fundamentals, though, principally. What are the major sources today and what are happening to them? The largest individual sources of industrial demand for silver, and industrial demand for silver is between 50 and 60% of demand for silver. But of the industrial sources, photovoltaic solar accounts for 10 to 15% of demand. EVs account for about another 10% of demand. Both of those buckets are growing at about 20% per annum, driven by their respective industries. And if we look at something like solar, we look through the solar supply chain and the solar industry. The solar industry has been fantastic for the last few years at thrifting and reducing the solar intensity of their cells. What has happened this year is that we have seen the Chinese solar industry pivot the technology, and they do this quite quickly, from PERC panels to TOPCon and heterojunction panels. TOPCon has a silver intensity per watt about 30% higher than PERC, and heterojunction is about 100%. So we believe we are seeing a step change in the demand for silver from the solar industry. At the same time as we're seeing really solid demand from the EV industry. And that's one of the factors that seems to be coming into people's minds now.
And the couple others you...
Look, let's talk about Goldfields, and we'll talk about New Gold as well. So Goldfields are a senior mid-cap, New Gold an emerging mid-cap. But for these two, and it's great to compare and contrast these with Australian listed companies, and this is part of the reason why we prefer these North American exposures for the quality of their fundamentals and the valuations that we can get them at. But Goldfields, globally diversified. Perception is it's got a huge South African heritage and exposure. The reality is that's been divested and shrunk and diversified away to being well less than 10% of production now. So South Africa is not a factor anymore. makes excellent margins, has got a fantastic outlook for the next 2 to 3 years in terms of growth, really attractive price to free cash flow valuations, a net cash balance sheet, and this thing is under-owned and not on people's radars. New Gold, a 2-asset company with significant growth outlook over the next 2 to 3 years, trading on a really attractive price to free cash flow multiple, and having just completed a transaction where they have bought back a cash flow royalty that Canadian Teachers had over one of their assets.
Beautiful. We're a bit less familiar with the North American names on Money of Mine, but I'll have to get into them. I want to finish with a bit of an underrated, overrated section. If you're up for it, I'm going to say a commodity, a stock, a thematic, and you can just let me know if you think it is underrated or overrated. To start with, the future of sodium-ion batteries.
Neutrally rated. The reality is we are seeing a proliferation of a range of different technologies, and as we move away from what's generically described as lithium-ion batteries being principally for mobility, different variants will suit different applications, whether it's different applications within mobility or stationary storage.
Alpha HPA, if you're familiar.
High purity alumina. Yeah. Too small, too illiquid for us. We struggle with such it's really quite a niche segment, and with something like that, like a high purity derivative product, how attractive does it need to be before a company like Rio Tinto Alcan is able to swamp that industry with supply? Not dissimilar to what happened in, was it Scandium, that Rio Tinto's QIT business, that incentive price was created, they put on an extra circuit which totally swamped that market with supply. Forgive me if I've got those particulars wrong, but there's a case study there.
Oh, good. How about the ramifications of the Inflation Reduction Act?
Massively underrated. We should have addressed that before, but there was huge excitement about it coming in, and we believe all of that excitement has evaporated. And if we is talking to companies on the ground in the US and talking to European companies who are moving operations to the US, it is not in people's revenue lines yet, but it's coming. It's working its way down. We're seeing factories get sanctioned. We're seeing some of those sorts of things. It's coming. It's real. It's huge. It's really material, but it's not actually affecting the revenue lines of these companies yet.
Do you think a change in administration would hamper anything there? Where
it looks like it's landing is on swing states on the balance of our research. Some good research going around about this. Our view is this is one of these things that will actually is really popular with voters first and foremost, and workers and industries, and it would be a brave Republican president who cancels that. This is great for US competitiveness as well.
Yeah.
If you think about a Trump presidency, what was some of his agenda items previously? Improving US competitiveness relative to China. This is critical to doing that. If you don't do that, you may as well give up.
How about Indonesian nickel supply?
Amazing and world-changing. Really tough for cobalt producers, given the byproduct and again the unintended exposure out of that. But it's so much so that nickel prices, the perception around forward nickel prices were that NMC batteries became, there was a massive shift in perception around those. I think it's fair to say we should be reevaluating the outlook for NMC batteries also as a result of that. It's extraordinary what they have achieved, but that's another great case study in the innovative potential of what can be achieved when there's an incentive price and deep demand.
One of my other questions was an either-or between what's going to grow stronger, NMC or LFP. As we'll slot that in now.
Like what I said, as we said before, there will be a bifurcation of markets where they end up.
Yeah.
There are huge benefits in both. It might appear, would have to check our notes and our research, but it would appear as if there's been more exciting innovation and breakthroughs in LFP in the last 12 months.
How about degrey mining, if you've looked at it?
Too small for us. Too small for us. It's and I'd have to go back to our notes to check.
No problem.
But it's, if you think about best ideas, it's a fair way below. And forgive me to anyone out there if I've missed something.
No problem. How about hydrogen as a potential, or its role in energy going forward?
Hydrogen is a polarizing topic. We have some issues with hydrogen. We break up the industry into three parts: the technology required to produce it, the technology electrolyzers, the technology required to consume it, fuel cells, and then industries and companies that are looking to use it and commercialize the use of it to profitable effect. We really struggle with the third bucket. At this stage, it is only niche or subsidized sectors that we can see that can really make it work. The applications that it looks most interesting for may require a carbon tax, certainly require hydrogen produced at a scale that will see unit cost economics compressed to levels which are hard to see and almost hard to imagine today. So it's a very long duration opportunity. That said, the order books for the electrolyzer manufacturers and the fuel cell manufacturers are continuing to fill. That's where our exposure has been focused, but it's pretty small exposure.
Do you think the growth trend, the consensus growth trend in electric vehicle adoption to 2030 is overcooked or under?
Consensus is what, 30 to 40% of total passenger auto sales by 2030. Our view is, if you look at China's commitments and just focus on China, China's going to enable much more than that by 2030. And China itself, which is at adoption rates or proportions of sales into the low 20s already. No, our view is there is upside to that, absolutely.
Another either or, this might have been answered through your sort of American first stance with Lynas and MP Materials, but choosing between BYD and Tesla, is it too much of a different case because you're not so focused on the auto space, or does the American win, or is there a different rationale?
Oh no, it's both there because they are separate markets, separate specialties. BYD, it makes slightly lower margins than Tesla, but at the present time, it's got a better growth rate, and they have got better in-house battery tech and better battery innovation, and their global market share in batteries is extraordinary. People should be thinking about BYD in the same breath as CATL.
That was another one I was going to say. CATL, is that under or overrated as the sort of market leader in that space?
Relative to perception, I think there's a reasonable perception that they're the world leader.
Yeah,
they are the world leader. They have exceptional innovation. Talking to some people deep within the technical aspects of that industry, think there is a bit of over-promising and over-promoting coming from CATL, but let's give the benefit of the doubt for now, and time will tell.
Yeah, they wouldn't be the only company.
No.
How about the notion that cobalt can be phased out of batteries?
Well, I think the chemists behind NMC would beg to differ, but further to what we were saying before about the byproduct that's coming out of it's not just a DRC story anymore. The volume of byproduct out of Indonesia is extraordinary and wasn't forecast by anyone when they made those assertions. So in this world, never say never, and we believe it's a really important thing to watch the cards as they come out of the deck, and if the world changes, then change with it, based on sound assumptions and sound fundamental research and analysis.
Last one, underrated or overrated, Franco-Nevada?
We have got a significant position in Franco-Nevada, and we entered it right at the peak point of Cobre Panama blowing up, which they've got significant exposure to, but we were able to, it's historically been valued on really incredible multiples. A whole lot of that's justified because of their risk profile and their growth profile is very different to a gold mining company. But the blow up associated with Cobre Panama provided an opportunity to get it at a multiple that you hadn't been able to buy it on apart from in the most acute crises over the last over more than a decade. And we were able to buy it without anything in the price for Cobre Panama. Our view was that was great buying. We love the stock. They're a very thoughtful company, very well-resourced company. A lot to admire there, and a really attractive stock.
Beautiful. Thanks for making the time and coming on Money of Mine, Roscoe.
Thank you for having me.
Good work, JD. That was good. I love a JD interview. They're their own style. They're methodical. They're in the weeds. And mate, you've carved out a niche within our niche.
Not so sure about that, but you're flattering, mate, and it's always awesome to hear what these fundies have always got something different. They're always plotting their own sort of way, so it's awesome for us to be able to, and the money miners, to glean the knowledge off of them.
Oh, mate, and they're getting a bargain. They get to come on for free.
Yeah.
What a bloody... Pretty much speaking of Silverstone's
free
charity,
bonus.
what about the Money of Mine charity that just happens every week?
We are a charity, Matty.
Mate, good people help good people, JD. It's my new saying.
Words to live by.
Yeah, courtesy of Mark Bowden, that saying. And speaking of good people, JD, the good people that help us, the good people, we've got VRIFY, we've got GetWet Solutions, DSI Underground, Silverstone, CRE Insurance, WA Waterboards, Brooks Airways, and the RC drilling experts, K-Drill.
Hoodoo, money miners.
Hoodoo, and diamond drilling, and aircore too.
They do everything.
Oh, just drill.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.